Hey everyone, welcome to Dollar Triage. Today we're going to talk about saving money, or more like not saving money. Saving money, as we've come to know it and why it's so difficult, is due to the structure of the markets, the structure of the economy, and a lot of the structure of our society. So saving money as you know it, as we were taught to do it in school, is dead. You cannot save money the way that our parents or our grandparents used to. It's unfortunate, but I'll explain why, and I will explain how saving money is a losing game and you should not save money, and why you should spend money. I know it sounds crazy, but stick with me. We'll get through it. So, the diagram I have set out here is the best way I figured I could represent the dilemma that we have and why saving is virtually impossible. So we're going to start with the fact that inflation, I need to change that color real quick. Inflation is 7.5%. And if you're not super familiar with inflation, that essentially means your purchasing power for $1 decreases 7.5% over the course of the year, or however it's being measured. It's usually monthly or yearly. There we go. I have no idea what I'm doing with this, so bear with me. The interest rate you get on your bank for your savings account, if you just stash money in the savings account, like we all do, you're getting 0.05% interest. That's what the bank's paying you to give them money, and that does not keep up with inflation, so we have a net loss. So let's say, for example, we have $1 million, because that would be awesome. And we put it in the savings account, and it's earning 0.05%. Now, that's not getting you very much. Inflation is 7.5%, so 7.5% of $1 million, $75,000. So what you have here isn't the fact that you're going to have 1 million minus $75,000 at the end of the year. It's just going to be that $1 million will buy you $1 million worth of goods and services at the beginning of the year. By the end of the year, those goods and services will rise in price so much that you can only afford the $925,000 value. That's what you'll get out of it, if that makes sense. So our interest rate that we're making by having it sit in the bank does not even come close to touching inflation. And that's a problem with a lot of things, not just savings accounts, but anything with interest where you are receiving the payment, like bonds, for example. So the bonds that we're supposed to hold, that we were told our grandparents would buy for us and then sit in the bank savings safety deposit box. So yeah, you'd sit the bond. Well, anyway, we'll go into bonds later. The point is, inflation is far outpacing everything. So even if you're trying to keep your money and not spend it, it loses value faster than you're probably saving it or getting paid to have it saved. This is why you can't save money for a house. If you're just trying to save money for a house, housing prices are going up 10, 20, 30%, depending on where you live. Your interest in your savings account isn't going up 10, 20, or 30%. So you literally cannot save for a house. And the houses are actually a great analogy. We can't accomplish our goals, especially us in the younger generation, our millennial group and the groups around us. We just cannot keep up with inflation in housing, in rent, in energy. So we give up. We're like, okay, there's no way I can save money for a house. I'm not making enough money to squirrel enough away and make enough interest on it to be able to catch up to what the down payment needs to be. So we go YOLO, and we're like, you know what? We're going on vacation. We're going to buy a car. We're going to buy a cell phone. We're going to have the nice clothes. We're going to go out to the nice dinners, because there's no point in saving money. And you're not wrong. That's exactly right. There is no point in saving money. And in fact, with inflation, since prices go up so much, you're better off using your dollars now, spending and buying, because it'll be worth less later and you'll get less later. That's only true as long as inflation is going up, and that won't always be the case. But for now, that's a bit about where we find ourselves with saving money. So if you feel like you can't save money, if you can't get ahead, if you can't catch up, you're absolutely right. And it's because of how the markets and the economy are structured currently. But this is part of the cycle. As you can see, this saving and the spending are two sides of the same coin. The spending part is also a social structure and economic structure. It's psychological, because we are just inundated and created and bred essentially to be consumers. We start out getting presents and gifts. We start out seeing advertisements. We start out watching cartoons and all the ads on the cartoons for breakfast cereal and toys, and we are grown into consumers. And that was the beginning of it, I guess, if you're an 80s kid like me, or a 90s kid even. But today it's a little bit different because we have social media with TikTok and Instagram and Facebook and all those guys. And since then, we've also significantly advanced the studies of the brain and psychology and the way neurotransmitters work, like dopamine. We figured out how to create a dopamine hit using social media and using our phones. So that's been, of course, incorporated into advertising. And what we've created is the social media dopamine mixed with this just ever-present demand for us to give people our money for things and stuff. And we're being manipulated into feeling like it's a luxurious expense or experience, or feeling like we're rich. And so the illusion of wealth is looking rich. So you have the Rolex and you have the car, you have the house, and you have all of your collections, and it looks great, but your net worth because of your debt is, minus $100,000. You're over your eyeballs in debt. That's not wealthy. That's looking rich. And that's because our society is telling us to always spend. We're just engineered for it. And what else are we going to do? Like in our society, you might be able to go out and do some recreation, but to do recreation, we always have to go buy the newest gear. We have to buy the bicycles and the kayaks and the running shorts. And so everything we do is touched by these cycles between social media, advertising, and spending. So we are just cash cows for corporations. They all calculate our lifetime value that we present to them, and they try to increase that and extract everything they can from us. So we're being squeezed with spending. The moral of that story is that buying is all we know, and we're really good at it. Because whether or not we wanted to participate in the structure of consumerism, buying is all we know. That's what we're really good at. That's what we do. And to go along with that, we're not given financial information. We're not taught that the interest on the credit card is also compounding. The buy now, pay later programs are not taught in school as being bait, essentially, for really, really bad credit issues that can come up if you don't make the payments. What we are taught are old ways of saving that don't actually work, and investing, like buying bonds, things that will never get you anywhere. So we're taught the old ways of how our parents and grandparents saved money, but we live in this new society full of this technology that's marketed to directly separate us from our hard-earned money. So we live in this cycle. We live in this cycle right there, just going around the loop. So we try and save money. Doesn't really work, so we have to buy stuff. We have to go grocery shopping and, put gas in the car and pay for the kids and do all that stuff. And we get payday. That's all we really look forward to, right? You get paid. You have maybe a couple days or a week's worth of money, and then you pay the bills, and you're like, shit, well, now I got to wait till payday. And then we go into saving mode, and then we get payday, and it's YOLO time. We spent the last week or 2 weeks, really buckled down and saving, and we did good. And now it's time to have some fun. And that's where this part of it becomes engaged. And so this cycle just repeats, and you're stuck in that cycle, and I'm stuck in that cycle, and we're all stuck in that cycle because we're supposed to be. That's exactly what's been engineered and created on purpose. So you're not wrong. You're not a bad person. You don't have any sort of willpower problems or addiction problems. I mean, We might, but we should get those treated if we do. But just if you have trouble saving, that's not like there's a character flaw. There's nothing wrong with you. You live in this system. So what do we do about it? I have the solutions where we can hack this and we can make this work in our favor for us because we're really good at buying stuff. That's what I want you to remember and take away from this. The difference between wealthy and rich is maybe a small distinction, but it's a distinction with a difference. And being rich means you look rich, you have a bunch of stuff, like we talked about, you're probably up to your eyeballs in debt, you look the part, but you are chained to your income, whatever it's job or whatever you're doing to finance your lifestyle, because you have to keep up on those payments, otherwise everything gets repoed and then you don't look rich anymore. Being wealthy means you are free of having to trade your time for money, and with the money situation automated and taken care of for you, you have time to do what you want, when you want, with whom you want, and where you want to do it. That is wealth. So there's a big difference between looking rich and being wealthy. Wealthy is time. So assets, liabilities, these are things we talk about. Either your eyes glaze over because you've listened to too many financial things and you're like, oh, this is business related. Or you may or may not have heard of Rich Dad, Poor Dad with Robert Kiyosaki. Recommend the book. It's a little bit dated, but the principles are pretty sound. The principles are the way we hack our way out of this terrible saving spending system. It's by buying assets. We're really good at buying stuff, right? So we have to get really good at buying assets and learning what liabilities are and getting rid of them and not buy the liabilities. The assets produce income, and the income creates wealth, which gives us time. And that's how we break out of the cycle. So what is an asset? An asset can be a lot of things. It's really important to know the difference between a liability and an asset. So the problem is we've been duped into thinking a lot of our liabilities are in fact assets. Because if you remember these guys up here, the marketers, the social media spenders, the corporations, those evil corporations, I mean, they're good at turning a profit. So what they've done is they've convinced the majority of us that you have liabilities, but they're in fact assets, so you should keep buying them. What am I talking about? I'm talking about cars, consumer electronics, your house. And okay, so I can hear half of you in an uproar saying my house is an asset. Well, that's a misteaching of some of that rich dad, poor dad stuff that's come into our culture. You are taught that your house is an asset, and it can be. Your house can be an asset if you're getting rent from it, if it's producing rent, if you are finding some way to create money with it with a business, or if maybe there's so much appreciation in price that you have equity in the house. Your house is worth more than what you owe on it. Right? Those are the ways that your house can be an asset. Now, if you're living in your house, you're not getting paid rent, you're paying the mortgage, no one's paying you. If you're living in your house and you have a job, you're probably not using it as a business, so that doesn't work. And the price going up to build equity, that depends on the market. And if you remember 2008, you know that's not always the case. So that's not a sure thing either. So you may or may not have an asset in your home. If it's your primary home, the best way to think about it is just as a liability. It costs you money to maintain it. You have to pay property taxes. You have to pay the mortgage. That's money out. Cars, same thing, unless it's a very specific type of collectible car that has a very significant value, something like a Shelby Mustang or something that's really unique and specific. If it's just a regular car that you bought and you drove around to work in, then that's guaranteed to be a liability. You have to put gas in it, and you have to insure it, you have to maintain it, and it might be able to convey you to and from your place of employment so you can have income from that, but that's about as far as you can take an asset label for a car. Electronics are the same thing. Cell phones, all this stuff gets replaced every year. Planned obsolescence. They know that they're electronic garbage is going to break in a year, so you buy the new one. None of these things that we're taught are assets. Jewelry, most jewelry, I would say 99% of jewelry, watches, rings, necklaces, especially watches, luxury watches, most of it's crap. Most of it's garbage. It's not an asset. An asset, you'll know if it's an asset if you can make money with it, if its value grows, if its intrinsic value grows, and it's not based on just a market that's popular right now. If you can go out and sell it for more than you paid for it right now, in the next 24 hours and get a good price for it, then it's an asset. Otherwise, it's a liability, and that's okay. So real quick, some financial assets. You can see the diagram here. We got stocks, we got bonds, we got bank deposits. So savings, pension fund. I wish we all had pensions. If you do, congratulations, you're one of the few. But things, that you think of like in the stock market. We also have more tangible things, physical assets, and I really like physical assets. Real estate, we've been talking about. Livestock, that's pretty random and specific to have on here. I didn't make this, so kudos to whoever did. Precious metals, big fan there too. Precious gems, less so. Very illiquid market, hard to sell into. Oils, I'm assuming they mean commodities like natural gas and oil, unrefined gasoline, that kind of stuff, where you can trade on the market, because commodities are wonderful. I don't think they mean essential oils, but I could be wrong. And collectibles. I also really like collectibles, but you have to really know what you're doing with collectibles. Most things that we're taught as assets are liabilities. Most things that we're sold as being assets are in fact liabilities. But things that are really, really popular can be an asset while the market is hot for them. Things like Pokemon cards, wine collections, whiskey collections, art collections, coin collections, gun collections, things that have real intrinsic, like historic value or rarity to it. I also really like the precious metals in the form of gold and silver, coins or bullion. These are fantastic ways to retain value over time and actually save money. They're very liquid, but it's a little bit of a pain in the ass at the same time. So if you want to save a bunch of money in precious metals, it's a great way to do it. And if you want that money back out, you can't just impulse spend it. You can't like grab cash off the counter and head out to the restaurant with your friends. I mean, you can grab a gold coin and try it, but I don't think you'll get very far. So that's actually a great way to hang on to some money. So it's a little bit of a mindset switch. We're going into buying assets and using our buying superpowers with a little bit of education and knowledge to determine what the liabilities are and avoid those, and then start buying the shit out of the assets. Buy assets like you'll never be able to buy them again, and keep track of them, but we'll get to that here in a second. So the difference between someone who's trying to save money and people who are building wealth is they have a system, and they keep track of everything. It can be a spreadsheet, it can be a journal and a notebook on paper, it can be whatever you want it to be, but they have a system. They have a roadmap. So they know what assets they're buying, they know why they're buying them, they know how much they want to have and keep, and they maintain the system. And it's a system that they like and they feel good, and they keep doing it because they enjoy it. And it gives you this dopamine. It gives you a replacement. And so instead of looking at ads and looking at things to buy because a company wants you to buy their latest purse or whatever it is, you get that same dopamine from looking at assets, looking at stocks, looking at precious metals or collectibles, looking at commodities, looking at real estate. And so you begin to use your superpower as a consumer to look at the things that will continue to build wealth, and you have a system to track it and create it. Now, I want to highlight, cash is important. Cash is very important. I'm not saying don't keep cash. We can't save money. We already established that inflation will eat it, and we can't save enough money anyway. And there's no point in saving it because we don't get paid and it doesn't produce anything. But that doesn't mean don't have cash. Cash is an asset. This bank deposit section here, can be cash in your pocket, cash in the bank, doesn't matter. Cash is an asset. Cash is important. Here's a little bit of an overview of a system as an example. You have to have an emergency savings in cash ready to go. Something like more than half, I think it was like 43% of Americans can cover $1,000 emergency that day without having to either borrow money, put it on a credit card, etc. So if you have $2,000 in cash for an emergency, then you're ahead of most Americans. And it's huge to be able to cover a water heater or a vet bill or a car accident repair kind of thing so you can keep going to work. That's huge. And that's your foundation. Honestly, I probably should have built this the other direction. So this is your foundation. You want to have this in cash in your home ready to go. You want to make sure that one, it's not accessible for you to impulse spend, and two, it's not accessible for someone with sticky fingers to find and grab, whether it's a burglar or the kids or a roommate or a neighbor that's over. You want to make sure that it's well hidden, it's secured, and it's just of enough of a pain in the ass that you don't want to go get it if you're like, yeah, I'm going to the bookstore, as if we had bookstores. But you want to make sure you don't lose it and that you can actually access it pretty readily in case of an emergency, because that's what it's for. So this system starts out with the emergency cash savings, and you grow that to $2,000 in cash. Saving money, stashing it away. Like every payday, you take out $200 in cash from your bank or your ATM, and you begin building that up. And once you have that maxed out, or whatever, whether it's $2,000 or whatever you want it to be, then you move on to the next. So you have an overflow. So this fills up like it's full of water. We'll call it full of dollars. So once it's full of dollars, and it spills over into the next section, and then you begin filling up the checking and savings account and make sure you have a balance of $3,000 at all times. And once you have $2,000 solid in emergency cash and then $3,000 solid in the checking and savings, you have a detached high yield savings account. By high yield, I mean most of these are like 0.5, half a percent. Sometimes I think I've seen even up to 1%. So if you're really lucky, you can get some kind of high yield savings, but this is a secondary emergency cash fund. Hitting the wrong button constantly. Sorry, guys. So this will be another tranche, another layer of your foundation, your financial mansion that you're building. So this high yield savings would preferably be in a separate account, in a separate bank with no debit card or credit card access, so you can't spend it. All you do, even better, is have direct deposit. Direct deposit directly from your paycheck to this account. We'll call it 1%. You'll never miss that from your check. And every single payday, you just put 1% in automatically, set it, forget it. This way, if you want to, say, start a down payment for a house or a car or Christmas fund, or to back up your emergency cash savings, you have this cash set aside that's being built automatically. And that automation and lack of access to it is phenomenal. The way you would access it is by initiating an ACH bank transfer from whatever bank's holding this to your checking and savings account. And that'll take 3 days, most likely 3 business days. Some obviously longer if it's a holiday or there's a weekend involved. So it does not happen quickly, but it can be quickly enough to make up for something that you need to take care of relatively soon. So once this fills up, once your high yield savings account fills up and you got $5,000 solid in there, everything else after that spills over into your investment account, your brokerage account. We'll call that $8,000 will be your goal. So you start buying, automatically investing into, call it the S&P 500 and the NASDAQ and all the big index funds for the stock market. So you're not picking individual stocks, they're low fees, and you just have a passive investment happening. And then you can set up the same direct deposit into a brokerage account with like Charles Schwab or Fidelity or E-Trade, or any of those will typically happily accept direct deposit. And then you can have automated investing, recurring purchases for your stocks index funds or ETFs. So you have an investment that's building automatically as well. And your goal can be $8,000 or 10 or whatever you want it to be. And once that's full and you've got a pretty good decent amount, you'd have 8,000 invested. You'd have 5,000 high yield savings. You have 3,000 working capital in your checking account, $2,000 in cash savings. And then if you want to say, just as a random example, it can be anything, doesn't have to be precious metals, but this is an example I like. You can start buying precious metals and you can have that as kind of a foundation of wealth. This is money and wealth that you will keep forever. It should not be something that's used as a down payment for a house unless you really have to. It should not be used in an emergency situation, that it can be. This is something that you want to ideally grow and accumulate and someday pass on to your kids or your estate. And this is how you start to grow generational wealth. So in this just little cascading system, we have a paycheck to paycheck living situation with no emergency savings to the beginnings of building generational wealth. And this is a very simple system. It's a roadmap. You can design it however you like, track it however you like. And what you're doing, if you notice, most of this doesn't actually involve saving money. Yes, setting cash aside, but if you go to the bank and treat your ATM withdrawal as a purchase because you're buying a cash asset, that mindset shift is invaluable. And you go from being a passive saver who's not doing anything, saving is literally not doing anything, to someone who's buying an asset. You have this ownership mindset and you have a purpose for what you're doing. That's the difference in saving versus not saving. With the checking account, the high yield savings account, same thing. You're purchasing cash assets. Index funds, ETFs, precious metals, other financial assets, these are things you have to buy. You shop for them. You look for good deals. You try and find things that are overpriced and avoid those. You can flip them and trade them if you want. There's capital gains taxes involved with that. But the higher end of the spectrum is buying, and it's awesome because when you start having a hobby such as coin collecting and you realize I'm spending money to buy this hobby and grow this hobby, you're actually growing and building wealth. That is the secret. And that's how we hack the system to break this cycle and end up in the wealthy section, end up in the wealth cycle rather than the paycheck to paycheck cycle. So all of this is based on knowledge. All of this is based on perspective, and these are things to learn about. You need to learn about investing. You need to learn about collecting. You need to learn what your goals are and how to execute them. So growing and seeking this knowledge and getting better at these things allows you to take care of these and allows you to take care of these even better. And the more you do it, the more you learn, the better you get at it, the more wealth you build. That's the way out of the cycle. There's a lot more to discuss in a lot more detail, but these will be other videos. I think that's going to be everything for me. And it's 30 minutes. We'll see if I can edit this. Take care.